midday, you got the Dow down about 0.2%, the S&P up about 0.4%, and the NASDAQ higher, up about 0.8% as we see some rebounding. You could see return on invested capital now, but then if you have this looming threat of these open source models abroad and what that means in terms of the overall equation here, how do you think about those two levers moving forward?
Well, so going back to your first question, what does the market want to see? It depends where you are in the market, right? So if you're in the Mag 7, you want to see that they either can tell you what the ROE is, right, or the ROI on it. If you're in the semis, you want to see budgets increase, right? So then the Mag 7 goes down. So there's no one answer. But look, there's so many other points at play, like China, right? Much cheaper chips, cheaper memory, everything's less expensive. So that may influence, I believe it is, the trading in Micron, SK Hynix, and all the others. So you have to look at all those. Bottom line is, I think we can all agree that CapEx spending is going to continue, and that the AI spending is not over. But that sort of disassociates from the stocks. So it's what the stocks are going to do, what the company share prices are going to do, and is it pulling forward the end of the cycle? Sometimes the cycle peaks in terms of the stocks a year ahead of time. I think that's where the debate actually is right now. Now, if you have a Meta that says, hey, we found our use for we don't know if it's to get into new business or if they bought so much capacity, which generally happens when markets get tight, right? You overbuy to make sure you have it, then you get stuck with it. So they foresee themselves getting stuck with this excess capacity, so they're offering compute out to others. So we don't know. So the way I've approached it is that I've exited Micron, I've exited Caterpillar, which is traded up because it's an AI play, and I'm sticking with Taiwan Semi, and I bought Broadcom because it was on sale and I bought it slightly below here. So it's a convoluted answer to a question that's just not easy to answer.
It's not.
No,
and that's why I figured we'd start the show with the hard one. Shannon, how do you think, Weiss obviously mentioned that it's kind of dependent on where we are in the cycle, and perhaps even more importantly, where the market expects the cycle to be moving forward. How would you kind of answer that question about where we are in the cycle and the market's appetite for additional CapEx from here?
So I think there's likely to be incremental increases if and this quarter. I mean, I think when we look at the first quarter, we would anticipate that most of these companies would come out with their sort of big bang number for 26 and, potentially with a little bit of a lens towards 27. I think that the appetite for the digestion, you have to look at not only the equity issuance that's happened in the market, but also on the credit side. If you look at, spreads have been incrementally wider for the hyperscaler credits over the course of the last several weeks. There have been some perhaps surprising issuance out of these companies, and then you start to look forward to 27, 28. Are we in a position where free cash flow actually becomes negative? Now, that's the question that really comes forth in the growth story. How much of this growth will be realized? How much additional cash flow can be generated by these companies to justify the spend that they've made so far? I don't think we're at the end of that. I think that there is still continuing to be meaningful demand. If you look at the denominator in terms of the number of companies that have actively invested in AI and put that forth in their core businesses as a strategic priority, there's still a lot of talk and a little less action. In some areas, a lot less action than talk. And so if you just look at financials, industrials, you look at healthcare, we are very early in sort of the demand pull in those sectors and in certain industries within those sectors. And so I think it's premature to say, okay, we're kind of topping out. But I would say I wouldn't anticipate that we would see kind of meaningful increases to CapEx announcements this week, in this quarter, just because I think that they've telegraphed through the end of the year, and we haven't really seen a big change in demand over the last, 3 months or so.
Yeah, I was surprised with the bank earnings last week, how token cost was basically a rounding error for most of them at this stage. They expect that to be higher in the second half of the year and going forward, but at least at this point in time, not a big margin compressor. Joe, you own Alphabet.
I do.
What would you like to see? in terms of CapEx color or guidance or announcements?
I'm going to take a little bit of a different perspective here. The market overall, it's kind of idling in place, waiting to rev the engine in one particular direction. If you're bearish, you're hoping it's down for a pullback. If you're bullish, obviously you're hoping for a continuation and new all-time highs. When I think about the CapEx, what is critical is monetization. And here we go. We are idling. We are waiting for what? We're waiting for earnings. Earnings have been the tailwind. That has been the single most dominant tailwind over the last 2 years. And we are waiting for them. We're going to hear from Alphabet. Next week, we're going to hear from Amazon. And if you think about the Mag 7, there are 4 of them who have had really strong performance so far year to date. You've got Apple, which has made a new 52-week high on Friday. And then behind it, you have your Amazon, you have your Alphabet, and you have your NVIDIA. And I think those 3 are critically important, Leslie, to where this market ultimately is going to go in the near term. Why do I say that? In the month of May, each one of those names made 52-week highs, and that was it. From there, they've begun to pull back. The S&P 500 could not continue to make new highs. Subsequent to that, June 2nd was the high for the S&P. So if earnings are going to deliver, you have to hear about one single word: monetization. There has to be monetization on the CapEx. Why did Alphabet make a new 52-week high in May? It was because Google Cloud was up 63% year on year. It's 3 straight quarters of acceleration. AWS, 28% growth rate. That was the fastest acceleration in 4 years. So that's exactly what you want to hear. You want to hear the proof point of monetization. You want to hear that it's real. Later on in the earnings cycle, we're going to hear from NVIDIA. And there it's just all about insatiable demand relative to supply. But we're coming into a really critical moment hearing from these mega cap earnings corporations.
At the same time, Friday with the sell-off, Alphabet, Amazon, Microsoft all declined over concerns that more firms would switch to an open source model, given what we've seen with some of the Chinese competitors, to save on inference cost. Do you think that kind of sell-off makes sense?
I think Friday was a liquidity more than a fundamental sell-off. I think it was just paring back of positioning as the market seems to lately be trading with a little more of a heightened sense of urgency, in particular because of the decline in the memory names and the semiconductor names. So a lot of times you have to look at positioning and you have to say to yourself, when you see that type of a sell-off, when you see a little bit of reversal in the price of Apple, when you see some of the mega caps go down, understand they're an ATM for portfolio managers. And it's really raising liquidity, getting cash availability ahead of a weekend where you have this geopolitical concern. I don't read anything more into it than just a near-term dynamic in the market itself.
I would echo that. I think that we have seen, I'm seeing additional questions around volatility. I'm seeing questions around the re-escalation in the Middle East. We're entering into a period where we still have a number of companies left to announce. But then we move into August. And August has been a challenging time the last couple of years from a liquidity perspective. We're staring down Jackson Hole with, potentially a mixed message coming out of the Fed, and we've got midterms. And so I think that ahead of some of this, it's, could we see this increase in volatility? Do I want to potentially pare back what has been a really nice first half of the year? We didn't see that as much right after the quarter ended. Perhaps that's a little bit of a lagged or delayed effect.
I look at it this way, that the bar is always high for mega cap earnings. In fact, the bar is always high for every company that's reporting, because we're seeing moves of 20 to 30%. In some cases, look at IBM at post earnings, up or down. So my advice would be to make sure you like the companies that you own, make sure you know the companies you own, and own it through the quarters. Because as we saw, these stocks recover. We've seen it in every single cycle. They still, despite the debt that they're taking out to finance the AI expansion, they can cover that debt. Debt coverage is not an issue for these companies. They print mounds of cash. So just own them through the quarters. Don't get all worked up about them. Don't trade around them, unless they get, for example, I've taken opportunities on Google. I think we all have, on Meta. on others to buy it if it gets significantly displaced relative to the fundamentals. So I think that's how you have to do it. Trying to guess what the quarter's going to be with so many levers they have to pull. How's cloud growth? How's ad growth, right? How's their spending? What's the ROI on the spending? So, not all are going to come in as you want to see them.
And I mean, news today, we had that Alphabet chart up. It's up about 2.5%. There is a report that says Alphabet is working on a new chip to enable its Gemini AI models to run 6 to 10% more efficiently. Sarah, what are you looking for on the conference calls as it pertains to China's moonshot, as it pertains to Alibaba's preview of Quen? What kind of commentary do you expect to hear on that front?
I think in addition to the fundamentals, I mean, Steve was talking about cloud growth for all of them in terms of what's advertising growth, what are they looking forward to? I mean, that's still very important for these stocks, right? We're so focused on what are they going to do with their free cash flow. Where is their free cash flow coming from? So let's get back to fundamentals on that. But I think to your point on GPUs and all of them doing TPUs, what is your cost coming down, right? We're going to see efficiencies coming down. Whether it's in memory, whether it's in semiconductor, whether it's data centers, where is that cost going to be contained or improved or be more efficient? And I think those companies that have that advantage. The other thing that's going to be interesting to see is all these companies that are using all this compute, are you going to go to the open source with China, or are you going to go to a closed loop for security reasons, right? So that's also something that we need to understand, because this is all your data out there, and that's all the customer data, whether it's, you're talking about businesses or you're talking about consumers. So that's kind of another thing to watch for, because you can have those moments on Friday and say, oh, this is a DeepSeek movement, here we go again. But in reality, what's really going to happen, or is this going to just make us all more efficient? And at the end of the day, then the folks that have the biggest free cash are going to win.
Yeah, I think there was a surprise that the Kospi was only down 4.5%. There weren't some outsized moves from SK Hynix or Samsung, and you're obviously seeing a bounce in semis today after last week, where the industry in the U.S. declined 10%. Semis underperforming the S&P 500 by 840 basis points last week, which was the widest underperformance going back to 2009.
Well, memory and semiconductor and semi-equipment went parabolic. And we're just now moderating that extreme momentum that was embedded there. So we're seeing a significant sell-off. With that significant sell-off, let's bring the word rotation in the conversation, because everyone's talking about
We made it 14
rotations.
minutes without rotation, though.
Right, exactly.
So
Great point.
kudos to us.
But there are rotations that continue to dominate the market in 2026. And you have to pay a price for rotation. The price for rotation is volatility. And it's tempting you to kind of exhibit the wrong behavior. I think it's important to understand that this personality of the market has changed because of what we've seen with memory and semi equipment, the fever breaking. I think the personality of the market is now wanting to pay a little bit more of a premium for the degree of safety. You have to ask yourself, okay, these Mag 7 companies, they do offer a degree of safety that I can't find in other places. I have yields rising back towards the high of the year. A 10-year is at 460. I think the high is 468. Mag 7 really doesn't care where yields ultimately go. Longer duration, semiconductors and software, yes, they do. So I think it's important, if they deliver here on earnings, to understand you may see capital push in that direction, but it's pushing in that direction not because the market's saying we want more risk. It's a risk-on element. More, it's a degree of safety.
Does that, Shannon, you think, kind of exemplify, in talking about the personality of the market, just the broadening trade? Is that a beneficiary of the AI pause? Do you get one or the other? Are they binary? Or do you see a world where they kind of all move up together, or the reverse?
I think realistically, if you look at the companies that are doing well in many of the broader sectors, it's because of an anticipation of some relative AI benefit, even if it's in parallel or a kind of a second derivative. I think that there's also an interesting component that's happening where if you look at some of the quote unquote defensive industries, for instance, I think portfolio managers are looking at them as a potential barbell. I mean, if you look at healthcare, you can think about, that potentially being an offset to some of this tech volatility, but there's an opportunity in that from an AI standpoint as well. And so I think that investors are looking at whatever you want to call it, value or cyclicals or the broader trade. The thing that maybe is not getting as much attention as it deserves is that broadening is supported by a strong economy. And the economy has been quite resilient. You look at retail sales, you look at jobless claims, you look at, kind of this steady, low hiring, low firing environment. You look at the potential for a more, sustained de-escalation in the Middle East. That helps Japan. That helps Europe from an energy cost perspective. So I think that what's being lost here is that we're talking about it being very binary. It's tech or everything else. I think we've moved well past that narrative. And I think that people should be cognizant of the fact that in an environment where global growth remains, at or above trend, depending on the economy that you're looking at, plus this accelerant of CapEx and industrial impulse, that supports broadening your exposure.
Weiss, do you think earnings, as we get further and deeper into earnings season, really helps support that as well? Because, the last few weeks we've had a bit more of a vacuum as it pertains to the hyperscalers, and we've had a little bit of semiconductor reports, but do you think as the weeks go on and we start to hear concrete numbers, we start to hear commentary that could provide a level of support? Or do you think that the bar is really high this earnings season and it could actually be a detriment?
Overall, the bar couldn't be higher this earnings season. I mean, I don't recall the bar being this high in terms of what analysts are forecasting for S&P earnings. And the pre-announcement period, aside from like an IBM, has been very, very light, as it has been the last few years. So
that's a good point.
Yeah. So I think so it's going to go by sector. It's going to go by S&P sector rather than overall, and when it ultimately washes out. So, but to your point, Jen, last couple of Augusts have been tough. So I think, going back to what I said before, I think you can drive yourself crazy trying to trade earnings seasons, any particular earnings season. So I don't know how you get in front of it. What do you do? Do you sell? Do you sell because you're worried, only to be surprised by a better than expected quarter or a quarter in line, or for the stock to recover shortly thereafter? It's the best thing to do. Well, if you have conviction in the companies you own, you stay in those companies. Now, if you think there's reason to be concerned, and most of these positions, particularly in semis, even though they're making lower highs, everybody still, I would say everybody, people that were in early have still made a lot of money. And I'd suggest, as I've seen in my own portfolio, that they could be outsized positions relative to what your normal risk management is. There I pare back, and that's just simple portfolio management. So my point is, I don't think you abandon what your portfolio management strategy is just because of all the heightened issues that we're seeing for this quarter.
Which could be what some of the recent sell-off is akin to as well, just this idea of portfolio management and some of these names becoming outsized
comes back
parts of the portfolio.
Has the stock performance peaked?
Yeah.
Based upon the cycle. That's the overriding question. If it is, then Caterpillar is still overvalued, significantly overvalued.
I mean, if you ask Edgar Denny, he was on the tape saying this morning that Infotech looks tired as we talk about kind of the personality of the market. He says there's AI fatigue and a lack of catalysts. That was from his note this morning. Sarat, do you agree with that? I mean, that kind of, to me, suggests, at least from a sentiment standpoint, that he thinks that it has peaked.
So there are a couple of things that could happen. One is money flows out of the market or just goes through the broadening phase. And we saw financials did very well. Right, but financials need another tail, and what could provide that is if you get decent earnings from the big tech stocks coming, then you can see more capital markets activity coming, right? On the other side is if you don't get good earnings, the market pulls back, then the IPOs coming could get deferred. M&A activity could slow down. So they're all counting on that as well. So I think you have economic activity, capital markets activity. You could have a base to the market. You could have a broadening still continuing on some of the other financials, industrials, and other areas that will partake in more capital markets activity.
Weiss, you mentioned gas prices earlier. Does it surprise you that people are still spending $10,000 on World Cup tickets and doing all of these experiences while gas prices are so high?
I just don't.
Or
believe
were so high, I guess. Now they've come down and coming back up
I
again.
don't believe there's any correlation between gas prices and World Cup tickets. You know, the consumer has shown. Look, we're extending credit card delinquencies, payback. So while all the banks say they're healthy, when they do their interviews, post-earning interviews, they don't get into the details. So spending's still going on. Credit card balances, of course, going to increase because 60% of the country, more so, lives paycheck to paycheck. So ultimately, gas pricing, it goes to the psyche of the consumer. So the longer they see high gas pricing, the worse it's going to get because they'll say this is for real. It's not going to be a blip as it has been in the past. And again, you have to have a view on Iran for this. So if the only exit out of Iran is, as Condoleezza Rice says, you got to take out everything there, I believe that also, then that means gas prices go up. Heating your home goes up. Everything goes up. So that's where you are. So I don't think the consumer's in great shape right now. I think the segment of the population that can spend for World Cup tickets, they're in great shape. And gas prices, whether it's $3.50 for regular or $5, just isn't going to matter to them.
Although in this most recent quarter, delinquencies actually went down sequentially and year over year, and net charge-off. But those banks tend to have higher FICO score customers than just the broader representation of the United States.
Exactly. So you've got to look at by sector, by segment of the economy to get true picture.
Airbnb, real quick, is a position that we maintain, and I would think the World Cup was beneficial for Airbnb. TBD on Uber, but that might also, the World Cup could have been a catalyst for Uber as well.
Yeah, there was that piece in the Journal about the cities, including my hometown of Kansas City, that were beneficiaries of new tourism. They probably don't have the hotel infrastructure to support that. So Airbnb's way to go. Up next, Mike Santoli joins us with his midday word. Welcome back. We are back on halftime. Senior markets commentator and overtime co-anchor Mike Santoli joins us with his midday word. Hi, Mike.
Hey, Leslie. Yeah, I don't know if today's action so far is really going to settle any of the big debates. Sort of the default mode of this market in the absence of any kind of big, incremental macro information or other jolt from corporates is dispersion. Most stocks are down today. The S&P is managing to go up. If I could sum up the street sentiment, I think coming into the week, it was semis have taken enough of their medicine. The momentum unwind might be getting washed out. And meantime, Mag 7 looks like it's been de-risked and looks cheaper on a relative basis going into earnings. It's all plausible, but I also think there's information in the fact that almost everybody is saying these are dips to buy. So to me, that's why we kind of stay stuck here in this 2-month range. S&P 500 kind of just riding the 50-day moving average. Maybe, Wednesday we get the big earnings rush. VIX futures expire for the month, and we'll see if that loosens things up a bit.
Yeah. We've got a few catalysts just starting a few days from now that could hopefully pull us out of that funk. Mike, thank you. Welcome back. Let's get to the setup on some key committee names reporting this week. First up, GE Vernova, which is reporting Wednesday before the bell. Weiss, you own this one, up about 8.3% over the last 3 months.
Yeah, so unfortunately, it's not one of my bigger positions, but because it's been pretty well. Look, I mean, this stock, as well as the others, well, it's VRT or FTAI, they definitely trade quarter to quarter. So as long as you don't, and the quarter should be fine. I mean, their backlog was significant. They can't fill all the orders they have. So where would the pressure points be on it? Pressure points would be if they had to add costs, which would hit the quarter, something like that, something unforeseen on the cost side, not on the order side. So I think the quarter should be okay. However, I don't think anybody here at the desk knows what the whisper numbers are these days on their highly volatile stocks. So that's where the caution is.
So focus on the margins,
it's not a cheap
maybe.
stock, right? So up or down could be pretty significant.
Yeah. Next up, United Rentals reporting Wednesday also after the bell this time. This one is owned by you, Joe.
Yeah, and a lot of times, Steve, to kind of offset that lack of clarity, you look at the option market to see what the implied move is going to be. In the case of United Rentals, it's 6.5%. This is a little bit of a complicated story that they're going to tell on earnings. Have to watch gross margin. It's probably going to contract about 10 basis points. When you're looking at rental revenue, probably up somewhere around 7 or 8%. Not exactly exciting. And then earnings itself for the quarter up about 9%.
It's a $1,000 stock. Look at that. Up about 26%.
Price targets generally run about $100 above where it is right now.
Yeah. remarkable. Stay with us. Final trades coming up on halftime.
All right. Hope you guys are doing well. We're going to take a quick break from the CNBC clips. We'll come back to those in just a moment. But before we do, I want to go over about 20 stocks and ETFs that they just discussed on the halftime report. And then we'll show you some more clips from today's closing bell, and then a little more analysis of those specific stocks and ETFs. Hope you guys all had a good weekend. I took a little bit of a break, so I haven't done any videos for a little while, but since last week. So let's talk about, I did make a members only video though, so just want to throw that out there in case you guys are interested in checking that out. This is what it looks like on my YouTube channel. Click on that button right there, hit the join button and select Blue Cloud Trader if you want to see this weekend video where I go over my entire portfolio. I go over the sectors, I go over the industries, and find some of the strongest stocks to consider for this particular week. All right, now, and I share those with members. All right, guys, so let's start off with the top 3 of the 20 stocks and ETFs that they just talked about. And why did I give these 3 a blue flag? They pass a specific test that is really important. It's called the Ichimoku test. It's a Japanese indicator. The idea behind it is to look to see if the strength of the trend is actually still strong. So what we're looking for is price to be above these 2 moving averages, the 9 period, the 26 period. We want price to be above this Ichimoku cloud that you see right here. And this lagging line that you see, the white line, which is the current price projected 26 periods into the past. All right, we want to make sure that that line is above the candle 26 periods ago. All right, if it is, that's bullish. We also have to have all of these lines in the correct order, with the green line above the red line, the single span A above the single span B. And you'll notice how the cloud itself actually projects into the future 26 periods. That's what makes it unique. It's based on mathematical formulas. For example, just to give you an idea, takes the midpoint of these 2 moving averages here, all right, projects that 26 periods into the future. That's the single span A. And the single span B, the purple line, is actually the midpoint of the last 52 periods, in this case 52 days, and that's what creates the other part of the cloud itself. The 9 period is the midpoint of the last 9 periods, and the red line here is the midpoint of the last 26. So we've got the faster, the slower moving average here, and then again, this is the current price, just projected 26 periods into the past. So we've got all the right elements here on the daily chart, and if you look at the weekly chart for Apple, same thing. However, with that said, we did have a down day today. It was down 2.14%. We can see the candle here that formed today. It actually gapped down this morning and then continued to drop. Here's a 3-minute chart so you can see what actually happened throughout the day today. And it is Monday, July 20th. There's the big drop, okay? It did start to recover, right? So it did stall around the 323 level and then moved up 0.87% towards the end of the day. But you know, overall, looking at this daily chart, I still think Apple looks pretty good. It should find some support even if it pulls back slightly more down to the 9 period. It should find some support there. Let's take a look at GEV. This is GE Vernova. It's in the utility sector under independent power producers, and this one here popped above the 9 and 26 period today on Monday. And if we look at the future cloud, that's bullish with single span A above single span B. We've got the Chigu span above price. Looks great on the daily. And you look at the weekly chart, we're still in a nice strong uptrend. Ichimoku stands for at a glance. The idea here is to not spend too much time on technicals. Let's understand the rules of the indicator itself, which was developed and incepted in the late 1930s, and then basically published in the late 1960s in Japan. We then started to adopt this here in the U.S. in the sometime in the 80s. It started to become more popular with financial institutions, and many financial institutions use this indicator, which is why I use it. And I also have another indicator below the directional movement index that also helps to sort of have a second confirmation. Let's take a look at XLF, and I'll describe this in a few moments. XLF is the financials. So the financial sector, ETF. And we've got a bullish cloud. Prices above the moving averages in the cloud. The lagging line is above price. All looks great on the weekly. All looks good on the daily. It was down 0.39%, but look, it stalled right there at that 9 period. just like it did back here, and then it bounced. Sometimes it will break under, and it may be a short-lived. It always has another level of support right below it, the 26. So right now we still have a series of what's called higher highs and higher lows, and that's what basically creates an uptrend, right? So we are in an upward channel. Financials are looking really strong here. And, if you look at this weekly chart, what I like about the weekly specifically is the fact that the directional movement index is also giving us confirmation. We get that confirmation when we see that green line above the red line. Okay, that's important. And the white line is moving up. Now, what does this mean? The white line represents the ADX9. I've got it at a setting of 9, which is a little faster than the typical setting. And if this is moving up, what that represents is momentum is increasing. You hear Joe Terranova talking about momentum. He should be using this indicator. It's going to help him probably a little bit to make better picks on high momentum stocks. The momentum started to, as you can see here, it was declining back here, right, in this area. But then it started to spike, right? It started to move upwards right about there, right? So if we go straight up, you can see that move up as well. By the way, this ADX, if the red line happens to be above the green line and that starts to move up as it did right there, that's not a good thing. Take a look. If we go straight up, that tends to lead to a decline in the price. All right. So what we're looking for is always the green line to be above the red line. And that's the positive DI9 above the negative DI9. Okay. Let's take a look at the rest of these. Now, as I mentioned, there's something wrong technically with the rest of these, which does not basically, they don't qualify basically to get that double check mark and blue flag that you see right here on both the time frames. So here's Amazon, for example, and as you can see, Amazon, it actually closed under the 9 period today, so that's not above it. That's not good. If we look at Amazon on that's the weekly chart, by the way. Sorry, that's the weekly chart. If you look at the daily chart, it's inside the Ichimoku cloud. And one of the rules of the Ichimoku indicator is that you should not be adding positions when price is inside the cloud or under the cloud, because that's bearish territory. You wait for the breakout, like you see over here. Okay? So no on Amazon at this time. Broadcom is under the cloud, so no on Broadcom. That's the daily chart you're looking at right there. It found support at that 200. That's that dotted yellow line is the 200-day moving average and bounced off of it, but it's still under these very important resistance levels. You've got Disney next here also under the cloud on the daily chart, so not something I'd be interested in. In fact, you even have that 200-day still declining with Disney, so no thanks on Disney. Google is still stuck inside this consolidation area, right? It's inside the cloud, which means basically there's no clear direction really, right? So it's just moving sideways. Look at the ADX, the white line, and when you see that thing flattening out like you do right there, that's what that represents is consolidation. It represents, balance, right? There's nothing happening. There's no momentum to the upside here yet. We need to see a breakout above the cloud. So I'd hold off on Google. If you look at Google, though, on the weekly chart, it's still holding up, and it's still technically in a pretty strong uptrend. We still have a series of higher highs and higher lows. It has found some support around the 26 period here, but it's been for multiple weeks now just kind of stagnant, right? I mean, we're talking about 2.5 months now where Google is just, we're talking about all the way from May 22nd. You can even go to the highs here of May 8th. It's been a while now where Google has just been slowly just declining. HLT is Hilton, and this one here is also on the weekly chart, still kind of just hovering around the 26. The daily chart, it's inside the cloud, so no on that one. Marriott, same thing, okay, inside the cloud. That's MAR is the ticker symbol. Meta is above the cloud. It is above the 200 and above the moving averages on the daily chart. What's the problem? Why doesn't it get the blue flag? Well, if you look at the weekly chart, it's still stuck in here. It hasn't taken out this high yet. So it's still consolidating on the weekly chart. Things are improving. Okay, so the directional movement index is starting to show some strength with Meta, but the price action isn't really. If you look at these candlesticks, we get a reversal candle here, what's called a red spinning top. It's still stuck inside the cloud. I would hold off on that. How about Micron? Here's Micron on the weekly. It's been declining for the last 5 weeks. but holding its own right above that 26 period. It was actually up 1.94%. Let's take a look at this on the daily chart. So it's inside the cloud. We had a bearish crossover. That's when you see the faster moving average, the green line, cross under the red line right there. Okay? So I would hold off on Micron, obviously, right? Does not get a blue flag. NVIDIA, same thing. It's inside the cloud. It's been stuck in this range. I mean, the highs were back in May 14th, and it's dropped about 13.7% since that time frame. RCL, Royal Caribbean Group, is still also stagnant here, just hovering around the 200. It's under the 26 period, no thank you, and under the 9 period. RSP is the S&P 500 equal weight. It's still under the 9 period here on the daily chart. On the weekly chart, it's still holding up. All right, so overall, I like RSP, the S&P 500 equal weight, but I would want to wait just for price to break back above the 9 period before considering it. SMH is inside the cloud, so that's the semiconductor ETF. No on that one. Check out the directional movement index below. Red line is above the green line, and ADX is moving up. Not a good sign for the semiconductor ETF. Okay, that's not a good sign, even though it was up 0.34% today. URI, the United Rentals Inc., which is an industrial sector rental and leasing services industry. Check out the directional movement index. It's starting to get negative, and you can see it reflected in price above. So no on that one. Volume is also increasing here. XLI also closed today under the 9 period in 26. I mean, it's been under here for a little while. Okay, that's the Industrials ETF, which is comprised of approximately 81 stocks that you see here. Okay, you can see a lot of negativity there, a lot of red. So I would hold off on XLI for now. We got 3 more, and then we'll get into the CNBC clips. We got XLK, the technology ETF, is still in a decline. We've got a series of lower highs and lower lows, and we've got a downward channel in technology right now. It's inside the cloud, and the red line is above the green line, so no on XLK. XLV, a little bit more bullish because it is above the cloud, but these last couple of days, see Friday here, July 17th, it closed under the 9 period, and there's a continuation to the downside here. On the weekly chart, it's above the moving averages. So we're getting a mixed signal with the healthcare. It's still technically in a nice strong uptrend on the weekly, okay? But on the daily chart, we need to see a little bit more change here with price. It needs to pop back above that 9 period. Right now, it created a lower high, unfortunately. So you can see the prior high, and there's the lower high, and as it's declining, let's hope it can hold up above this 26 period. That's the next level of support. That level right there is about the 157.20 level, okay? XLY's, look at this, consumer discretionary, just kind of stuck in a box, as I like to call it, stuck in a box. And so it's consolidating still. There's nothing to do here with the consumer discretionary. In fact, it's reflective down here in the directional movement index. Take a look down here, what's going on. See that red line crossed above the green line. Then the green line crossed above the red line. It's just like a lot of crisscrossing happening. And that ADX is pretty flat the whole time, or dropping, which means that you should not be adding positions here. Okay, you go back in time a little bit. We'd have to go. Let me switch it to a weekly chart so that will show you a little clarity, more clarity. Like for example, back here where the green line went above the red line and the ADX started moving up, you can see that nice move there. It moved up about 26% in just 3 months. All right, so that's what I'm talking about. That's what we're waiting to see. We don't have that yet with XLY. Now what we're going to do is we're going to get back into the CNBC clips from the closing bell, and then I'll cover more stocks and ETFs right after that, and I'll go over a summary of what happened today in the markets, guys, because the markets, as you can see, dropped. We'll get into that. We'll take a look at the heat maps as well. So stay tuned for that. All right, let's get back into it.
We are back with final trades. Sarat.
Morgan Stanley stock's up about 10%, off 10% since its earnings. Nothing's changed. It's just I think people just taking money out, but great company though.
A little bit of that R word rotation. Weiss.
Same call with Goldman Sachs. It's down off what was a phenomenal earnings for the best on the street. And so I think it's a good place to buy right here.
And Shannon.
Energy still cheaper on a relative basis. You don't have to have a higher for longer crude call.
Joe.
I'll see your energy and raise you the refiners. They really are the strongest momentum in the market right now. Valero, PSX, MPC, diesel's above $5.
All right, that does it for halftime.
Welcome to Closing Bell. I'm Sarah Eisen, in today for Scott Wapner. This Make or Break hour starts with the AI trade front and center as we gear up for the tech earnings later this week. Here's your scorecard with 60 minutes to go in the trading session. And we have the S&P 500 unchanged. We're off the best levels of the session. Little bit of a comeback in the tech and media names today after the big sell-off last week, though off the best levels. Energy, communication services, and information technology remain higher. NASDAQ 100 is up 0.4%. So is the NASDAQ Composite, up about 0.2%. But we're seeing some pressure on the materials and the healthcare, staples, industrials. But we are seeing that nice tech rebound right now after big sell-off is again Google front and center. That takes us to our talk of the tape. How should you position yourself for the big week ahead? Joining me now to discuss, Trivariate's Adam Parker, JP Morgan's Jordan Jackson, and CNBC contributor Hightower's Stephanie Link. It's good to see all of you guys. So, Adam, what changed? Last week, they were sour on the chip stocks and the tech stocks. We start off the week and things feel a little bit better.
You know, I think you have to run a diversified portfolio, right? This last couple of weeks is a perfect example. We're recommending semiconductors, but also healthcare and energy. Last week, healthcare and energy, best performing sectors last month. This week, they're selling off. If you don't run balance, you're either going to be up a lot or down a lot. And usually when that volatility starts, it doesn't end super quickly. So I think what you're finding out is you got to run a diversified book. And I expect the earnings season to be pretty good, to be honest with you. The number one message, simple as it is just don't own things that miss. And you saw that with IBM last week. You cannot.
Easier said than done.
You just 70% of companies meet or beat earnings. So you just have to make sure that you don't say, well, I know current conditions are bad, but I'm a long-term investor and I'll own it for the recovery. Like, you can't do that. Cheap stocks missing, getting killed. Bad momentum stocks missing, getting killed. So I think you just want to own the businesses you have confidence the margin numbers are good.
Like which ones for you?
So I still think semis are good. I think the sell-off there was too harsh. We came on the air last week and said I think Micron's a buy. I think you look out at the end of earnings season, the tech sector's higher. But I need to diversify that because it's a pretty risky bet. So we're recommending healthcare services. We're recommending energy, where I think the numbers are achievable. And then select things in financials and industrials.
Energy outperforming today on some higher risks around Iran. Jordan, one of the questions is, this day-to-day momentum trade, just how much leverage is behind it. People are starting to look at things like retail positioning and leverage, and whether that plays a role in the day-to-day swings without a big fundamental driver or change in CapEx, for instance.
Yeah, it is something that we're monitoring very, very closely. And leverage is one of those things that doesn't cause a market crash, but certainly exacerbates one, particularly if it's to the downside. And so right now, you've got leverage funds sitting at roughly $200 billion in AUM, a little bit more than that, $500 billion worth of notional. That's a pretty sizable number. Not only that, when you think about a lot of retail investors who've got margin accounts who are borrowing on margin to either go long or so that again exacerbates some of the liquidity challenges within the market. So it's something that we're watching very closely. What's also interesting is just there's now more U.S. listed exchange traded funds than publicly listed stocks. So you can trade the market more than actual stocks to trade, which I think is pretty remarkable and just a reflection of. I think it creates, more challenges. I think this introduces structurally higher levels of volatility, and so we just have to kind of manage around some of these technical factors.
Do you think that? Does it change your fundamental view of the market right now?
Not necessarily, right? Because earnings are incredibly strong. They're phenomenal. Now, we have to recognize that a lot of that is still being concentrated within AI. We're projecting that for 2Q, about almost 70% of earnings are going to be driven by tech. And a big piece of that being driven by semis, about half of that being driven by semis. And you boil that down to just 3 names within the semi names that are driving the bulk of that. So it's still very concentrated. We do anticipate some of this broadening out a little bit here, but it's still, very much a tech-heavy story.
Stephanie, how are you positioning into the week? Have you made any moves?
Well, yeah, I've been adding to NVIDIA. I actually bought that for the first time, Sarah, ever, last week and a half ago. Been buying Morgan Stanley because they have a phenomenal quarter, and Well, but I own Broadcom, and actually in the last year and a half, Broadcom has outperformed NVIDIA, and it's been a phenomenal stock. So NVIDIA, the story is just a valuation call on my part. At 18 times forward estimates, it's the cheapest it's been since 2019. And this is a company that has mid-80s revenue growth. They have mid-70s gross margins. Cash flow is going to double. It's totally out of favor. Everybody wants memory. Nobody wants to own the very best in the business, and I want to own the best in the business on sale. Morgan Stanley had a phenomenal quarter, and in fact, the big six banks had tremendous numbers last week. On average, the big banks grew earnings 53%, revenues 22.5%, net interest income up 14%, and investment banking fees up 43%. Morgan Stanley has pulled back 10%. And they have one of the highest profitability metrics, the ROTCE, in the industry, 2 quarters in a row of 27%. So I want to have more exposure there. And then United Healthcare clearly has gotten its mojo back under Hemsley, the CEO. It's taken him a year. But we should have taken a cue from him May of last year when he bought $25 million of United when he returned to the company. So he's turning that story around. So I think there are a lot of different ways to play in the market. I think the economic numbers last week were tremendous in terms of less inflation. What that bodes well for PCE? I think it will. Retail sales, I've never seen 8.4% retail sales growth. The Philly Fed had the best current activity levels since November of 2021. And again, another week of very low weekly claims. All of that we care about because it's going to feed into earnings. And I think the 20% expected growth for this quarter, earnings growth, is going to handedly beat. And I don't think it's just going to be technology, especially since I just cited what the banks just put up.
And also some of the things that you just mentioned on the consumer, which, Adam, I just want to mention with you because you wrote about it this weekend. This idea, Wall Street's been fretting for a while about a K-shaped recovery where, high income does well because of assets, low income, not so much. You've been sort of digging into this and what the ramifications might be for consumer discretionary. What do you think?
I don't think it's quite accurate. Meaning I think the K-shaped thing is more of a balance sheet than an income statement thing. And I'm not an economist, but unemployment's low. People have jobs, they're paying their bills. If you look at the credit card data, you're seeing a 90-day credit card delinquencies are below long-term averages and came down last quarter versus the previous quarter. You're just not seeing the stress on the day-to-day income statement. Sure, people aren't participating in the balance sheet as the wealth effect happens on stocks and other things, but they're paying their bills. One of the things that's interesting is of the public consumer discretionary companies, we looked at the number of them that have, the percentage of them that have higher than 10% short interest. It's at a multi-year high, the highest you've seen since the financial crisis. Now, some of that is winners and losers, but I think probably that's too negative in aggregate into the earnings season. And so we upgraded from sell to hold, underweight to market weight the sector. I think there's probably some opportunities to, get into the names that have exposure to spending being more robust. And I don't want to be as negative as kind of 15, 18-year high on short interest seems too negative on the discretionary.
You think it's a little too unloved? I'm looking at discretionary now. I mean, it moves sometimes with oil.
It does.
It's down 2.5% year to date.
Yeah. Now look, there's some losers there that probably won't make it in the long term. Whether that's a Target or a Kohl's or other things that probably have business model challenges.
It's a bold statement.
But multi-year. But I think they just can't compete. They're subscale with Amazon or Walmart or whatever, Costco. But I do think that I wouldn't want to be short the most number of consumer discretionary stocks in 18 years into this earnings season. I agree with Steph. I think it's going to be a pretty good earnings season across the board. The other thing that comes up a lot is this breadth issue. And I was just looking at this. The S&P 500, if you rank the best performing stocks kind of 1 to 500 this year, if you look at the Mag 7, I mean, Apple's been the best 134th best stock in the market, followed by Google, 234th best, and all the rest are below median. So people have been wanting the breadth. Like, you're getting it. You're getting it. The Mag 7 have lagged a ton. One of the things I worry about a little bit is that you could see them do a little bit better through this earnings season. And maybe people have been a little too negative on a relative basis. So I like this point about adding to NVIDIA. I think actually the Mag 7 plus Broadcom, the grade 8, might outperform a little through earnings season.
Yeah, it's true. I mean, you do have groups like healthcare, communication services, materials, real estate, industrials. They're all positive year to date. But let's home in on tech right now, because Alphabet shares are getting a nice boost today following a report that the company is working on its own chip. This, of course, ahead of earnings, and it's a more efficient AI chip from what we hear. Mackenzie Sagalis has the details. Mackenzie.
So, Sarah, with earnings just 2 days away, Google shares finally catching a bid after a rough stretch that has the stock on pace for a third straight monthly decline. But the catalyst this morning is a report that Google's developing a specialized AI chip specifically for Gemini. Codenamed Frozen V2, it would reportedly build some of the model's logic directly onto the silicon itself, potentially serving up to 10x more tokens per unit of power than Google's current flagship chips. That could strengthen Google's full stack advantage, designing the models, chips, and cloud infrastructure together while easing a shortage that's reportedly forced its cloud unit to turn away business. But deployment isn't expected until 2028. And in the meantime, Google's paying SpaceX nearly $1 billion a month for additional capacity. But the lab still faces execution questions. The next Gemini Pro release is delayed, senior researchers have left, and Chinese rivals are narrowing the capability gap. That is the backdrop as DeepMind chief Demis Hassabis meets with lawmakers today and tomorrow in D.C., pitching a federally overseen, industry-funded body to test advanced AI models before release, just as Commerce's top official in charge of AI testing steps down after just 3 months on the job. But the bigger test comes Wednesday for Alphabet, when investors will look for proof that the company's record AI spending is translating into faster cloud growth and a stronger backlog. Sarah?
Okay, Mackenzie, thank you very much. Mackenzie Sagalos. Stephanie, where are you on Alphabet?
I don't own it, but obviously I care a lot about it because it's going to have an impact on some of the other names that I own, mainly Broadcom, because they supply into Alphabet. So this is going to take a long time, I think, to launch. Mackenzie's right that there's a potential, execution that needs to be flawless to get it out in 2028. Maybe it gives them a cost advantage, but I don't see them severing their relationship with Broadcom. There's just too much that's needed, and there's just not enough of anything at this point in time. So I applaud them for continuing to aggressively spend, although as an investor, I kind of want to see a pause in the aggressive spend because I want to see the ROI, and I don't think we're going to get a lot of that from the Mag 7s this quarter.
And notably, Broadcom is up 2%, even though Google's rallying on that idea of its own chip. This gets to the spending question, Jordan, which I know we talked and you said you're getting a lot of questions and discussion from clients around whether, these CapEx numbers from the hyperscalers continue to go up this earnings season. Is that ultimately good or bad for investors at this point?
Well, I think ultimately it's bad because it spells danger for operating margins and it spells danger for ultimately free cash flow. Right now, this quarter, we're expected to see CapEx across the hyperscalers account for about 95% of operating cash flow. We're actually expect that to eclipse 100% by the end of the year. So being a negative free cash flow position without that turning positive potentially until the earliest second half of 2027. And so I think this is a real crucial point, for the market, even more so than the Iran conflict. I think if a headline flashes across the screen that says hyperscalers cut or reduce overall CapEx intentions, that's going to be a bigger rally for the market than U.S. and Iran reach a ceasefire.
Do you think that would be a good thing? Because then wouldn't the chip stock sell off on that kind of headline?
Perhaps. But again, the markets are moving away from the spenders to the receivers, which is one of the reasons why we saw that initial rally, initial run up. Maybe it went a little bit too far, a little bit too fast. And so we're seeing, giving some of that back. You can't grow earnings to the degree that some of these memory and chip stocks are growing earnings in perpetuity. And ultimately, they're now talking about needing to bring on additional capacity and increasing spending in order to support this broader build-out story. So this can only run but for so long. Look, I still think there's some upside, right? But I think you got to be very active and very selective about where you're shopping across the tech stack. Right?
How do you think of the CapEx?
I'm mixed on that.
Yeah.
I have some sympathy for the point that maybe if Microsoft reduced their CapEx, it might rally because it's been such a laggard, and I think people are a little bit more concerned about the exit multiple for cloud in a few years and other things that are specific.
I think the software story.
Yeah,
there.
I'm not 100% sure, but I hear you. It's evolved. 6 months ago, I would have said you need to raise CapEx. It needs to be Goldilocks. It has to be up a little, at least, so people think it's game on, but not up too much because they'll be worried about its free cash flow issue. I think that's changed 6 months later, and I think maybe it's a little more company-specific now into the earnings season. But at the end of the day, part of me thinks the market's assigning too low a probability that the CapEx is actually a good thing in the long term, meaning that these stocks have underperformed by too much in the last 6-12 months.
The Mag 7.
The Mag 7 plus Broadcom and grade 8. And I think that the reason is, let's just assume there's some pretty smart people at some of these companies, maybe.
We know that,
Yeah, a lot smarter than the Wall Street idiots that we all hang around with too much, present company included. And maybe that what they're really doing is distancing themselves from everyone else in years 3 through 10 more than people think. That some of this is going to create a bigger
But even to
moat.
Steph's point, if you can't measure the return on investment so soon?
No, Steph's right, and George's right, but it might be that you don't. We were told this isn't going to be till 27 anyway. So you're going to get fits and starts with people believing the dream or innocent until proven guilty on that path. But you're going to get proof cases for sure. And the question is, do I think we have another major leg up in the exposed companies tech? Yeah, I do. We could get a harsh sell-off like we've seen Micron, 1,300 to 850. Like we get harsh, but remember, in order to get a 10-bagger, you're going to get a 50% downdraw at some point in that happening. And I just think we're in the middle of a big uptrend, and I don't think this is the. It's definitely not the beginning of the end.
The question is, what do you want to be
beginning.
in that as that unfolds? Do you want to be in the hyperscalers that are doing the spending? Do you want to be in the chip stocks that are receiving the spending? Do you want to be in the other stocks, the other enterprise stocks that are buying the tokens?
I think the bottleneck hunting that people are doing, it's going to oscillate. They want infrastructure. At the end of the day, compute semis are going to grow way above GDP at higher margin, and that trade's not over. So I like Broadcom and NVIDIA and Micron, all of them right now, and I think they outperform from here through the end of the year and through the end of next year. If you get this transition on the CapEx coming down for the hyperscalers, you may get a period where the other ones work too. And I think people are a little too negative on Google, Microsoft, Amazon in a long-term view.
Well, I do want to be clear that it's not that I'm calling for the hyperscalers or the grade 8 to pull back on CapEx. I'm just saying if that were to come out, I think you'd get a very, very powerful rally in the market because the markets are very much focused on the CapEx and to Stephanie's point, kind of that ROI picture over the next several quarters.
And the increasing debt loads as well.
Absolutely.
All right, we got to leave it there, guys. Thank you very much. Great discussion to kick off the week. Adam, Jordan, and Stephanie. Welcome back to Closing Bell. Gas prices topping $4 a gallon nationwide on renewed fighting in the Middle East. That pain at the pump could have a major impact on some key retailers. Joining me now to discuss is Michael Gunther. He's Consumer Edge's Senior Vice President of Research and Market Intelligence. They get all the sort of point of transaction consumer research. Michael, it's good to have you. I kind of feel like the story has been higher gas prices hasn't translated into the consumer pain that we were all worried about as much.
Yeah, I think there was a lot of anticipation of the consumer cracking. You have seen certain signs of weakness, but overall the consumer's held up quite well, especially on the high end. What we're looking out for now is which retailers and restaurants have the most exposure if gas prices continue going up and stay up, because their consumers allocate, as a starting point, the highest percentage of their total spending to gas.
And what?
So it leans more value oriented. So think of retailers that tend to cater to lower and middle income consumers. Dollar General, Dollar Tree, Ross Stores, Burlington, Walmart, those sorts of names. But then also drive dependent retailers. So retailers and restaurants that have more of a heavy footprint in rural and suburban areas where people just tend to drive more, fill up their tank more. And that's places like Tractor Supply, Dutch Bros, Texas Roadhouse, Boot Barn as well.
Are you warning about these companies, or have you guys already seen it in the credit card data that you
We
track?
haven't necessarily seen a big downdraft in those companies relative to others, but these are ones that see an outsized impact, and where we saw the share of wallet increase by the most amount among large companies compared to Q2 of last year.
Why do you think the consumer's been so resilient? Do you think it's because unemployment has not gone up? And
That's likely a big part of it. Of course, on the high end, asset prices have helped. We are, however, seeing some signs of higher income consumers not necessarily pulling back, but being more discerning about how they spend. So dollar store growth, for example, and this has been going on for months in our data, dollar store growth has been driven most by high-income consumers. Same thing goes for resale. So they're not necessarily pulling back, but they're looking for ways to save money.
Yeah, I mean, the fast food sector has also been, I feel like, a little pressured. I don't know if that's a gas story or something else.
Yeah, so one of the areas that we saw weaken a little bit from February, which is pre-war, to May, which was the peak of gas for the moment, was quick service on the burger side. companies like McDonald's, Burger King, Wendy's benefited from promotions, especially at the end of last year. And now those are starting to turn down a little bit relative to February. And even in June, as some sectors did a little bit better, you're seeing other restaurant categories start to come off a little bit in the data.
What, is that a gap in value between buying at the grocery and going out?
That's a big part of it. Look, supermarkets are leaning more into full meals that you can buy that are alternatives to going out. We're finding that companies that are able to clearly illustrate their value are doing better. The ones with sort of muddled messaging, maybe not so much, but it doesn't necessarily mean the high end is coming down. It's you need to prove there's value here.
Is there a level of gas prices where you really start to see the pain?
Well, peak May prices, we were seeing about 170, 180 basis points year over year of that share of wallet growth. It's come down to maybe up 50, 60, and now recently in the last week gone up 100 again. But look, even in May, we saw certain signs of cracking, but we did not see a consumer completely buckling.
I do wonder if, the tax refunds was a big part of that story, because that was something that did happen and coincided and helped sort of cushion that blow.
No, absolutely. And one of our data sets, we can actually isolate tax refund recipients to understand, where their spending accelerated relative to the rest of the population. So that helps tell us who benefited from that. So
is
cruises,
that still a tailwind, or is that over?
It's probably over. It's been a while now, but cruises, big ticket furniture seem to have benefited, but home furnishings overall have been pretty weak. And that's an area where you see the gap between high and low income pretty pronounced, among other areas like travel as well.
All right, Michael, always good to talk to you, get granular with your data. We appreciate it.
Thanks for having
Michael Gunther
me.
from Consumer Edge. The NASDAQ trying to snap a two-day sell-off. It's higher, as you saw, the Dow's lower. But our next guest says the charts point to more trouble ahead. Fairlead Strategies founder and managing partner Katie Stockton joins us now. What's worrying you, Katie?
Well, last week we saw the NASDAQ 100 index take out short-term support. That was based in part on the 50-day moving average. You can see it starting to roll over as well. And listen, that does increase downside risk because the next support is pretty well below 8 or 9%. And the same would be the case for the S&P 500 if it were to break down below equivalent support, which is defined also by that 50-day moving average. In addition to our cloud model, we're putting that level right around 73.40 for the S&P 500. Importantly, both indices have been somewhat coiled up in these consolidation phases. And when we see the consolidation phases resolve to the downside, it can be associated with a big pickup in volatility. So we're sort of bracing for that right now. And clearly the downside leadership is pretty localized from the semiconductor sector in the broader AI trade.
I was just going to ask, where in the AI trade or where in the NASDAQ are you seeing it? It's the momentum names, is the memory chips?
Yeah, I mean, listen, it started in June, actually even in early June, when we saw the relative pullback in AIQ, which is an AI-related ETF. The biggest position there is SK Hynix. Second is Micron. So it has very big exposure to these types of names. And we felt that that was like an early indication of the loss of momentum that we are now sort of trying to recover from. The 20-day moving average rolled over first in June, and now, of course, it's pointing lower. We've had a series of short-term or minor breakdowns. Thankfully, now the AIQ ETF, after nearly 19% downdraft from the high, is near some additional support. So we're looking for maybe a few days of stabilization that could give people a chance to kind of regroup and decide which names they might want to reduce exposure to as they bounce.
What about the rest of the market for a moment? We're heading into earnings season. Do you see any interesting opportunities in the charts?
Well, listen, I mean, there's been such a rotation, right? So even as semis have underperformed, we've seen that rotation into software that we've been talking about for some time. And there are even still breakouts underway in some defensive areas of the markets. Even the REIT sector looks like it's trying to break out. So this is not really a broad-based move at this time. If we see the S&P 500 break down from its coiled up consolidation phase, then that would probably be a drag on just about everything. So we would use that almost as an indication to be hedged partially from a top-down perspective, especially focused on that high beta segment of your portfolio. But otherwise, there is usually safety to be found, of course, in the likes of healthcare, REITs, utilities, all of which you can find some really good technical setups, certainly from a bottom-up perspective.
Yeah, I mean, that's where you've seen the biggest strength over in the last week, which is real estate, consumer staples. I'm curious what financials have told you, because we got these great earnings reports pretty much across the board. And this, I mean, the S&P Financials Group over the last week is pretty much flat. It's an underperforming sector year to date. So what do you glean about sort of the setup and earnings reactions from what we saw from this group?
Yeah, it was a pretty muted reaction is the way I would put it. I wouldn't say it was bearish, but it certainly wasn't a bullish and welcoming reaction to these earnings reports. So I don't know if it bodes for more of the same from the rest of the market, but it kind of went off with a whimper, if you will. And the charts look okay. I mean, they're still long-term uptrends, consolidation phases within that context. The relative performance, as you mentioned, it has really been under pressure for financials overall this year. But again, there's some spots of strength. I would encourage everybody to look at insurance stocks, or insurers have been really very strong in relative terms. And with that, we've seen a lot of breakouts from a bottom-up perspective there.
What about, I mean, I also want to ask you about energy, best performer so far today. And, you know, look, it's hard to predict what happens in the Strait of Hormuz, what happens if the Houthis get involved now. They're threatening a different waterway, which is critical for energy shipping. But overall, on the charts, a lot of people have been surprised that we haven't seen even higher prices on the level of oil.
It's been really curious because there have been a few days where we see both energy and technology as the biggest gainers on the day. And that's somewhat counterintuitive, you would think, because energy is, of course, tied to crude oil prices. I think that has to do with the mega cap complex contributing here in an oversold bounce. Without the mega caps, I think there'd be a bit of a problem for the S&P 500 and those technology benchmarks. But thankfully, they've been contributing to the momentum there, or at least the recovery in the indices. So we really need those mega caps to show up here when we lose the AI trade. But energy in particular, from a bottom-up perspective, we are also finding some interesting setups, not breakouts per se, but oversold upturns. So we've been talking a lot about how the oil companies have come off of oversold lows on improved short-term momentum and also improved short-term relative performance. So we think it is meaningful because we saw crude oil come into key support in the high 60s per barrel. So we think that's a higher low for crude.
Higher lows. Okay, got it. Katie, thank you.
Of course.
Good to take a little trip around the market with you in the technicals. Katie Stockton. HSBC's Max Kentner talk us through the close. Should American investors be, first it was DeepSeek, then Kimi, Baba, as Kate mentioned, should these be like major moments for rethinking the AI trade?
No, I don't think so. I think the DeepSeek moment was a bit of a shock moment because we didn't know how far or how advanced really China's AI progress was. And on the back of that, we really did have then this big earnings increase back then as well in Chinese equities. That's probably a little different now because when you look at Asia's tech, when you look at Hong Kong tech shares, a lot of them are more the sort of the Babas, the Tencents and so on. And I do think that actually the hyperscalers in the US, they are probably a little bit better positioned here, both in terms of profitability, but also in terms of the bar to beat now going into the Q2 reporting season as the reporting season now really heats up this week and next week.
Yeah, so I was going to ask you what looks good into earnings. We're going into a heavy week.
Yeah, I think it is more the hyperscalers than the semis. So I'm really leaning into the hyperscalers. I think the bar to beat, not only in terms of the numbers, is actually quite low, but also in terms of the narrative. In terms of the numbers, when you look at tech overall, consensus is basically saying earnings are going to grow sequentially, quarter over quarter, by about 12.5%. But this all comes from semis. Semis is about 28%. The rest of tech is minus 1.5% in terms of expectations. So that means, you know, I think the hyperscalers, the Mag 7, do face a really low bar to beat, and also in terms of the narratives, because let's face it, if one of the hyperscalers says, you know what, we're not going to increase capex growth even more, or maybe we don't even have to issue as much debt, or maybe things like, hey, maybe we won't be free cash flow negative in the next couple of quarters already. There's a lot of negative expectations already baked into the Mag 7 that they can actually surpass, i.e. the narrative bar is even lower, I would say, compared to the numbers.
So you like them. All right, Max, thank you very much for joining us ahead of the bell. That's Max Kentner from HSBC. As we head into the close, we are seeing a little bit of a boost from the communications sector. Thank you, Google, or
Okay, so those were clips from today's episode, Monday, July 20th episode of Closing Bell. We're going to look at about 11 stocks and ETFs from that show that you see here on the left-hand side. We'll also take a look at the indices today, the SPY, the Q, the Dow. We'll look at FEZ, the Euro stocks, silver, gold, oil, Bitcoin, Ethereum, which was up 3.08, copper, miners, ETF. So let's get into the stocks first, and then I'll cover these. So let's take a look at Target. That was the only one that got a blue flag today. As you can see here on the weekly chart, price has been steadily moving up since it hit this double bottom. So let me show you guys what that looks like. It's right here. All right, we get the first bottom here. First bottom, moved up, dropped to that same level, bounced, broke above the high of that level, and you can see the expansion there, right? So it's actually, Target has moved up from the lows here of 84, 85, about 64.5%. That's a big move. The Ichimoku cloud has been bullish for a little while now. Price has been above the Tenkan-sen for a while, since it got above here back on April 17th. It was finding some resistance, as you can see, at the 200-day moving average, right? But it broke through that level, and now it's still continuing to the upside. ADX is moving up. That's a weekly chart. This is multiple weeks here. Let's look at the daily. Here's the daily chart with a series of higher highs, right? So this is really important. Prices above the cloud. There's the 200-day moving average, which is now rising, because Target had a big drop. If we go back a little bit here, let's take a look at the weekly chart again of Target. At one point back in 2021, November, it was around $275, and from that level, it had dropped approximately 68% over a 4-year span. Okay, so now the fact that we've actually are starting to recover is pretty big. It's significant. And so I like Target right now at these levels. It's still very strong. It's in the early stages where price has gotten above the 200 and above the cloud. So this is good. Let's look at these other ones here. AIQ is an ETF, the Global X Future Analytics Tech ETF. Here it is in the weekly chart, pulling back, finding support at the 26 period. The Kijun-sen is what that's called. And it looks like it's going to bounce here. Let's look at the daily chart. It also found support right inside the cloud. The problem is it's inside the cloud in the daily chart, so you want to wait it out basically, because now we've established a downward channel and that needs to be broken. Okay, so you can see that very clearly. I would hold off on this one for now. Let's take a look at the next one, DG, which is the ticker symbol for Dollar General Corporation, a discount store under consumer defensive sector. On the daily chart, it just recently emerged above the cloud. It had a big drop here as well from back in February. It had dropped approximately 36%. Now it's up over 24% from the lows here, and it's above the cloud. But what does it look like on the weekly chart? Because this is just in the beginning stages. And on the weekly, it's still under the 200. It's still under the 26 period, and it's finding some resistance at the top of this cloud here. But as you can see here, it has been steadily moving up. We do have a positive directional movement index, but it's not a perfect chart. The Chikou span here, the lagging line, the white line is still underpriced, so it's not a perfect chart, and therefore it does not get a blue flag. DLTR, Dollar Tree Inc., another discount store, is above the cloud on the weekly chart. However, the cloud is bearish. That's when you see the Senkou span A under the Senkou span B, the light-colored blue line under the purple one in the future. And then what else? The lagging line, the Chikou span, is still underpriced. All right, but it looks like it's doing all right here in the week. Let's look at the daily chart. You can see that we've recently merged. It's moved up about 13% since it. I take that back. Since it moved up here, it's up a little over 10%. Next one, DRAM, is the ticker symbol for Roundhill Memory ETF. You can see the directional movement index is still very negative here. The ADX is moving up as price is declining. We are, in fact, in a downward channel here on the daily. Is this a short-lived situation? Let's look at the weekly. It could be, potentially, if price this week or the next starts to bounce, and maybe this 4-week was a little pullback, and now we could potentially see it recover, but there's no evidence yet, so I'd hold off. IGV is still hovering under the cloud, so that's also bearish on the weekly, and on the daily it's under the 200 inside the cloud. No on that. McDonald's, MCD is the ticker symbol, is under the cloud on the daily, under the cloud on the weekly. No thank you on that one. MTUM Momentum factor ETF has been pulling back as well on the weekly chart. Again, this is kind of similar, right, to the DRAM. It's pulling back, finding support around the 200. I'm sorry, the 26 period on the daily chart. It's inside the cloud. This could potentially be a bull flag pattern. I've talked about that one before. It's when price moves up steadily, and then it creates a very short-lived pullback, right? And that's the bull flag right there. So I don't know if that's going to happen. If price gets above the highs of those levels there and breaks this trend line and gets above that cloud, then we could see the next leg up. But right now, and it was up 0.18%, so we'll see if that can actually happen. All right, let's take a look at the next one. UNH, United Health Group. Let's start with a weekly chart on this one. It recently emerged above the cloud, but look where it's stalling, right at that 200. In fact, last week, it created a shooting star type candle, a reversal candle. So it's still hovering right above the 9 period, the green line. It's still hovering above the cloud itself on the weekly. The ADX is still positive with the green line above the red line and ADX moving up. But we need to see price start to change course and continue, instead of moving sideways here, start to pop. On the daily chart, yeah, it's just consolidating still, and you know, we need to see a little bit more out of this right here. It's not the time to be adding positions as price is weakening here. WEN, the Wendy's company, restaurants, right, industry. It's above the 200. Let me see, 785, and yeah, it's barely above that 200-day moving average, above the moving averages here, but we had a negative crossover. And so if you look at the weekly chart here on this one, it's still in a very decline, embedded decline. And I mean, there seems to be a little bit of movement here. You can see that we may have created a new double bottom pattern right there. But until it actually breaks inside the cloud and through it, we don't have that confirmation. It could be short-lived, this little move up. Now, their next earnings are on August 7th, as you can see here in the box above. So we'll see if that changes. If they come out with positive earnings, that could be the catalyst that makes it pop. And sometimes you can see a big percentage move up. The 200-day is still declining here on the weekly chart as well. I mean, you go back to the all-time highs of Wendy's. You'd have to go back to this this candle right here, June 11th. It was around 29.46. It's down 74% from that high. So the price of sales is ridiculously low at 0.59. The PEG ratio is 1.02, which is a nice ratio. It still has good sales growth rate. Profit margins are 6.77%. But until you see more action, a little bit more volume, and there, like I said, there's been a little bit more volume. You can see this big volume bar here back on June 26th. It was significantly higher than all the other candles down here, the volume bars. So, and that's also when we had this candle here, this bullish engulfing pattern. So again, we'll have to wait and see on Wendy's, but there seems to be some volatility happening here. XLE energy is still stuck under the cloud, but it has been moving up, and from the lows here, it's moved up 9.38%. Here's the weekly chart. You can see it's still above the moving averages. We did have a negative crossover just this week so far, so we'll see if this can correct itself, but it's not perfect. I'm not giving it a blue flag here yet. Let's look at the 30-minute chart. You can see here in the 30 minutes, since the 13th of the month, July 13th, it's been moving up about 3.7%. All right, now we're going to look at the indices, but before we take a look at these ETFs here, and by the way, none of them have a blue flag. Before we do that, I want to show you guys what's happened in the markets today. So we're in FinViz Elite. By the way, this platform, the software that I use here, there are links for this as well as the charting platform that I use, this one here. If you go to my channel, just go to Blue Cloud Trading on YouTube. Click on this, 10 more links. If you do, this pop-up comes up. Scroll down. From here, you can become a member. You can get the $25 coupon for the TC2000 charting software that I use. There's the FinViz Elite affiliate link. These are all products that I use, like Wise.com, and I do use Inago for property management software. I've used NordVPN, and I still use it actually. And these are some of the other areas that you can see that you might find of interest as well, like my Twitter page. All right, let's get back, folks, to the channel here and look at these. Oh yeah, I was going to show you guys the got sidetracked there. Dow Jones down 0.59% today. The U.S. stocks, okay, closed lower as rising oil and Middle East tensions offset early chip maker strength ahead of heavy big tech earnings slate. Okay, some of the interesting things that are going on. Traders looked ahead to earnings from GM, Alphabet, Tesla, and other major names alongside an ongoing monitoring of Middle East developments, oil price stability, and potential fallout from the U.S. tariffs on Canada for direction into Tuesday's session. So that's what they're going to be looking at. And what does it say here? Former President Trump announced 50% tariffs on a wide range of Canadian goods, including autos, dairy, alcohol, adding to trade tension worries with limited immediate stock-specific impact. All right. And let's see what else. Yeah. Okay. Let's look at these again. Nasdaq down 0.05%. The S&P 500 gapped up in the morning, but then dropped and was down 0.19%. And the Russell 2000 also gapped up in the morning and dropped. Everything gapped up actually, right? Dow, the Nasdaq, it all looked pretty rosy in the beginning and then dropped. While we're here, I just want to show you guys like a company that I invested in early as an accredited investor, BXBL, that became public just recently, and it's trading at 9:53 after hours. But yeah, Boxable. I don't know if you guys are familiar with this company, but you should check this company out. It's kind of interesting, I think, in what they do. It says here Tuesday 4:05 a.m. I'm sorry, today 4:05 a.m. Boxable surged 35% in debut after completing the Boxable SPAC merger. If you're unfamiliar with what this company does, they build small, tiny homes. I'll show you guys. They should have a website here. Let's. Oh, this is more stuff regarding their merger. But if I was to, let's see. This is their YouTube channel here, Boxable. So they've set up multiple factories already, which is kind of interesting. And this is what the whole thing is all about. Let me just show you guys a quick little video here, just in case you're curious about what they do. They the boxes. I mean, sorry, the boxes. The homes. They unfold like an origami and create these very inexpensive, like $60,000 homes that have everything in them. So they're like tiny homes, which I think is what's kind of necessary in our country right now. We need to essentially, you know, get more housing out there, make it more affordable. But yeah, they've set up some factories already, and they're doing pretty well. They've come up with different versions of it, even this little tiny one for $20,000, which is kind of interesting. So yeah, I think that could also help with the homeless situation that we have in this country potentially, and hopefully this company does well. Anyway, let's get back to. But yeah, I made a shocking amount of money from becoming an early investor. I did not expect it. I'm not going to get into the details of it, but I made a relatively big investment like back in 2021, and now it's like paying off like big time that they went public since they went public this week. All right, let's get back into the stocks here. So the SPY ETF. Let's look at the daily chart. It closed under the 9 period for a second day. Here we were on Friday, July 17th, and here we are today, Monday. As you can see, the red line has been mostly above the green line on the daily chart this whole time. And it's evident by the price. I mean, price has been stagnant and slightly declining here, right? It's just not moving much. It's there's not a whole lot of action with the SPY. Maybe the earnings announcements are going to be the catalyst, right? Here's the Qs also declining. And now the QQQ ETF, ironically, closed up 0.10%, just slightly. But yeah, it's not looking very bullish here either on the daily chart. And the weekly chart, we're still under the 9 period as well. The Dow is holding up above the 9 period. All right, Dow Jones ETF on the daily chart, it's under and finding support at the 26 period. Russell 2000 closed under these two moving averages. The VIX down 0.64. That's the volatility index. That represents the moment, what's happening in the markets as far as volatility, and we want to see that declining. It typically has a positive effect on the markets. FEZ, the Euro stocks, is still sort of stuck under the moving averages, but technically, did it close inside the cloud? Let's find out. 67.18. Yeah, it did close inside the cloud today, the Euro stocks. And I also don't like what's happening here. The directional movement index starting to spike up, but it does still seem kind of stuck in a symmetrical triangle pattern. If you look at, let's see, maybe it broke that symmetrical triangle today, actually. Take that low there, draw that trend line across. It looks like it did close under that trend line for the first time today on Monday, but it's hovering right above the low of this candle, so that's good too. Here's a weekly chart. Yeah, just not a whole lot of movement here in the markets recently. They've just been stagnant. Gold is still declining here on the weekly chart, down 0.22. It's inside the cloud. We might get a bounce here potentially. A lot of times that happens. Price comes down, finds support right at the bottom of the cloud, and then starts to pop. Daily chart, yeah, I mean, it could potentially create a double bottom here, potentially, right? There's no guarantees in the market what's going to happen, but we are stalling at this range in this dollar area. Okay, so it moved up, dropped to that same level, and now it's kind of like gapped up a little bit, and then just stayed around the prior day's closing. It was only down 0.22%. And if you look at silver, that one gapped up 0.39%, but it did create a lower low. So silver's still hurting a little. Oil K is up 0.42%. That's the ProShares K1 Free Crude Oil Strategy ETF. That's moving up since it hit the 200 here back in July. It's moved up 14.77, but it's still under the cloud on the daily. IBIT. And by the way, guys, I mean, you want to get some of the profits from a company or an ETF like this in the earliest stages, and you don't mind trading a shorter time frame, which, okay, you can switch it to a 30-minute, and you can get in and trade it based on the 30-minute chart. But just keep in mind that you have to really watch it closely, and it's more time consuming when you do that. But yeah, as you can see here, it popped above the cloud right here back on July 13th. It's moved up 7.22% since then. Bitcoin on the 30-minute chart is above the cloud on the 30-minute, but on the daily chart, it's still hovering under the cloud. So no on Bitcoin at this time. What about Ethereum? Ethereum has penetrated and entered the cloud again. So it did that back here on July 15th. It pulled back, found support at the 9 period, and now it's bouncing off that 9 period. That's actually kind of bullish. The directional movement index has turned green here. The green is above the red. The ADX is still flat because price isn't really moving that much, and there's not a lot of volume here to substantiate this move, honestly. So I wouldn't be too, excited about it. But if you look at the 30-minute, just emerged above the cloud again, breaking above that cloud. So that's always a positive, and I wouldn't be shorting it here for sure. Copper miners ETF on the 30-minute is under the cloud. On the weekly chart, it's above it. Okay, and but it's under these moving averages, so that's not good. And on the daily chart, it's under the cloud. So again, not something I'd be interested in here. What's interesting is we had a bullish candle, a reversal candle right there. Price moved up, came right down, never took out the low of that candle, and now it's up 0.7%. So this too could potentially become a double bottom pattern, and those are bullish. So that does it for this video, guys. Thank you for watching, and thank you for supporting this channel. And if you really want to support the channel, what you could do is hit that like button, hit the subscribe button, share this video with someone you know that might be interested in learning about stocks. They might be talking about stocks, but this could be helpful. And then you go to my channel, Blue Cloud Trading, and click the join button, like I said, and select Blue Cloud Trader if you want to get access to the weekly member-only videos, like the one I just did this weekend. All right. You can also request up to 2 stocks or ETFs be analyzed on an upcoming video. If you want to go to the next level, Blue Cloud Legend, you have to make sure you select the correct level that you're interested in. Hit the join button here, and you'll be able to get those exclusive member-only videos. You'll also be able to request 3 stocks or ETFs per month to be analyzed. And you can also get access to day trading videos that I've recorded, as well as, and this is the most important thing I always say, is the daily stock and ETF trades update, which I do. Basically, I submit in a post to all Blue Cloud Legend level members daily before the market closes. Today it was around 1 o'clock that I posted it, and I shared the trades that I placed, the ones that I added. I added 3 new stocks. I closed out of 3 positions, and each weekend I go over my entire portfolio. So you kind of get more insights from these member-only videos. If you do want to learn, I think it makes sense to try it out for a month and see if you're, most of the members are renewing each month. So we've got a big group of members, and I appreciate all of you guys. Thanks for watching. I will catch you all in the next video.